last year, I think interest rates, when we had Bash, interest rates were really starting to rise. Now, we're in a totally different debt environment at this, this year. We've had some SOP changes, and we got some fun stuff to talk about. So these guys do a lot of SBA panels all across the country at the business schools, at every conference you can imagine. So I really want to emphasize that this is SMBash. So let's hit them hard. Let's grill them. Let's have some fun with it. Let's get some real answers. Let's pit them against each other, and so we can see them fight on stage. But no, so I think the three things we're really going to talk about here are simple. We're going to talk about process, we're going to talk about deals, and then we're going to talk about changes and trends, things that are specific to this point in time, SMBash 2024. So without further ado, we've got Matt Dolsky from Byline Bank and Lisa Forrest from Live Oak Bank. Why don't you guys introduce yourselves?
Sure, I can go first. So yeah, Matt Dolsky, Byline Bank. I've been with Byline Bank for most of my SBA lending career, which is a little over 15 years now. And yeah, specialize in 7A lending. I think I stumbled into my first search deal accidentally 6 or 7 years ago, and it was a pest control company in Florida. And I had no idea what search meant or anything like that. And it's funny how you kind of just accidentally, what you kind of get into in life. And, fast forward about 3 years ago, I just started exclusively doing self-funded search deals and, all across the country. And then 2 years ago, our management asked me they must have fell on their head and asked me if I would start a self-funded search vertical within our bank. So now it is all I do. So, from 7 years not even knowing what a self-funded search deal, was, to exclusively only doing it. So, we're one of, only a few banks, Lisa as well, that really have a focus in this space. We hope that that's beneficial to everyone here, and I'm sure we'll talk about a lot of that today.
Hi, I'm Lisa Forrest. I'm head of our search fund lending division at Live Oak Bank. And this is my 37th year lending?
No.
37, yeah, it is. So I've been at Live Oak for going on 8 years now. With my then partner, Heather Anderson, we brought the search fund lending division to Live Oak Bank. And it is our vertical, so one of our 40 plus verticals at Live Oak Bank is self-funded search. I think we were really one of the pioneers, if not the pioneer of lenders to focus on self-funded search. We go after it as our 24/7 as well. And we love it. The momentum has really exploded. It has been very popular for business acquisition for my 3+ decades anyway, but now it's gotten a little fancier. It's gotten a little bit more methodology around it. A lot of resources and content out there for searchers, which is really, really exciting. And now that we have competitors, that we're friends, we're competitors, and it's actually really amazing to be able to pick up the phone, call your competitor that's dedicated to this space. We have our own little kind of side ecosystem too as lenders also that do this, and we share resources, we talk, and it's just nice to be able to come to this kind of environment and collaborate. There is plenty for everybody. There is just plenty for everybody, and it's about kind of being mentors and coaches at this point, especially for me personally. I have my colleague Sarah Andrews here as well, my lead lender, and it's just great having environments where we can help one another, because being the next generation of business owner, it's needed. It's a real thing. So I'm so glad you're all here.
Great. Yeah, that's awesome. So we are going to, I've got some questions for them. We'll save time for a Q&A at the end, but please do not feel like you have to wait till the end to ask your question. Just throw your hand up. And like many other panels. Yeah, right.
No, please.
Maybe wait a little bit. Yeah.
And we're going to say, just shout them out too. Yeah, I mean, this is really casual. That's why we're here at this particular conference. So
Exactly. Feel like we're in your living room right now. So cool. So let's start with the basics. All right. So I'm a searcher. I think, I'm going to go the 7A route, right? I've read about it. I've seen it online. That's what I'm going to do. When do I start talking to you guys? What questions are you going to ask me when I do?
I guess I can start with it. So That's a good question because I think the answer is different. There's some lenders out there that will say, I don't want to talk to somebody until they have an LOI. Until you're under LOI, don't call me because I don't have time. I mean, I've always taken the approach of, if you have something about a deal, you want to talk about cash flow, you want to talk about structure, you want to talk about the LOI, because a lot of times, without talking to a lender, you may enter into terms into an LOI that are not SBA eligible. For the seller note, for instance, has certain provisions where the interest rate cannot be higher on the seller note than what the bank note is. So there's just things like that where it's a good idea to talk to a lender before you get too far into the process. And that's always hard. I mean, that's one of the things that honestly is a struggle, though, too, as a lender, because you want to have those upfront discussions, but also that can make for a lot of people tugging at your time, as well as the deals that you're working on that are like in underwriting and closing and in pre-qualification. So I don't know that there's like a right answer to that question. I think at the point where you are starting to conceptualize either an IOI or an LOI, I think at that point it's definitely time to talk to a lender. But I wouldn't also say that there's like, that there's no like too early either, if that kind of makes sense. I don't know if you'd agree with that, Lisa, but that's kind of how I think about it.
Yeah, I'll just add on to that. The momentum with the self-funded ecosystem is amazing. We love it. In fact, it's our 24/7 day job to help promote that and to find the acquirers. I will tell you the amount of time placed on service providers, it is pretty significant. So at least Sarah and I, we've created some processes around hopefully efficiently speaking to you as soon as possible. We have a weekly office hours. We have our new to search acquirers attend. We do it every Wednesday, every Thursday. We talk about everything SBA. We share deal vetting templates with you on Thursday. That's a good starting point for us. And you can't be too early. We have folks going into their MBA programs that aren't even going to be graduating for a couple of years, but they're really curious about search. So we have you start with our office hours. And then when you want to talk to us pre-LOI, and we welcome that, because you're probably going to look at 3 or 4, 5 deals that you want to show us. You're looking at hundreds. We understand that. But if you want to talk to us 3, 4, 5 pre-LOIs, we have a process for you to do that. So it's efficient for us. And then also, we want you to do some homework. Do not just send us the SIM and say, what do you think? I have a broker meeting tomorrow. Can you structure this for me? And I know that sounds ridiculous, but we get those practically every week. Here's the 50-page SIM. Clint tells me it's perfect, but could you go through Clint's 50-page marketing document, structure this for me, and get back to me at the end of the day because I have a broker meeting tomorrow? That shit happens. And I will tell you, this is a partnership between you and your lender. You're interviewing us. I get that. We're interviewing you too. So we've put some processes together so that we can efficiently, time management-wise, talk to you as early in the process as possible. But we kind of want you to do some homework too.
The homework part is a really great point because yes, you do get those emails from time to time where somebody says, I had one once where they said, I'm looking at 4 different deals and here's the financials on the 4 different deals. And if you could look at them and tell me like what you think financing would look like. And to the homework point, like when somebody doesn't really put any effort other than just shooting you an email and saying, hey, can you do all this stuff? That's where it's maybe in, my opinion, it sounds like in your opinion, maybe putting a little bit too much on us right up front. And like you said, it is an interview process, and that's not the best look either to come to the bank and say, hey, it kind of makes it look like you're either, you didn't do the homework or you don't know how to put it all together, which neither one of those things is very good. So just to add on to that a little bit.
Yeah.
So in theory, talk to us early. And we're going to do some work for you. You have to do some work for yourself too.
Right. Yeah, no, that's great. Let's expand on that a little bit because I think that's really important. So you want to talk to you guys early. You want to get ahead of it, certainly ahead of LOI, but we don't want to be annoying, right? As searchers coming in, we know, we want to respect your time. And as you guys said, it's an interview process. We want to also look good. So do your homework. How else can we not be annoying as searchers coming to you? Because, we know as service providers, there are some that are a little annoying. So how do we avoid that?
Well, I think you just gave a really good example with
Yeah.
like here's something and I have a meeting at 8 a.m. tomorrow with the broker. Can you put this stuff all together? Unreasonable requests on time, I think would be the biggest thing. I haven't come across too many folks that are like, you know, 8 phone calls a day or like, I don't think you see too much of that. I mean, everyone, is, pretty sophisticated and cool in the space, but I still think there's some of those, unrealistic maybe time demands on how quickly we can put something together for you that you might say is a little annoying.
So I would say preparing as best you can. And I know it is so competitive right now, and we really do appreciate that. All your service providers, I'm speaking kind of on behalf of Q, be an attorney as well, and insurance. We know it is so competitive for you out there as buyers. And we know you have to move urgently. And sometimes you literally have to move that next day. So we get it. And so I would say that there is a process to be forming a relationship. I know at the end of the day, Byline and Live Oak, we're going to give you a loan to start. It sounds transactional, but it's not. So the relationship building, that's where we're going to really get to know each other. And it is a relationship. So just understanding that there are so many buyers out there, we get it 100%. It's just a matter of being prepared yourself and appreciating that on any given day, we could have this many people calling us, and just appreciate that your CPAs and your attorneys are getting that as well. And we want to be there for you. We're very collaborative. And that's why we're, 2 of the top lenders, because we're super collaborative with you. Just maybe appreciate the time constraints on our side too.
Yeah, no, that's good. So just as you said, Lisa, there are a lot of buyers, and there are a lot of buyers. I think it's evident, by these type of events. There's a good handful of lenders as well too, and each lender kind of has different qualities. Of course, different value propositions across lenders. They're not all created equal, and we're not just talking percentage points here alone. So flipping to the other perspective, now I'm a searcher. How do I make sure that not only I'm a good fit for you, but how are you guys a good fit for me? What should I be looking for in a lender, aside from just rate?
You want to take that? Sure. So I think it's important to know and if you have some of these conversations like we've been talking about, you'll figure some of this stuff out. There's certain banks that like certain things about different aspects of deals, and I think it will save you a lot of time. And when you are under LOI, you do have kind of these time constraints, right? You have the period of exclusivity, where there are certain banks that there's certain industries that that banks may or may not like, things tied to residential construction, heavy manufacturing, depending on what your buyer experience is. We have different thoughts about cash flow. Every single lender does. I don't think there's probably any of us that are the same. Customer concentrations. I mean, there's all kinds of things where, like, if if you have a thesis about what you're kind of looking at, and you have some conversations, you'll probably be able to figure out, like, okay, that bank, Live Oak may be the best fit for this type of deal. It seems like they like that. Byline, you guys may be a better fit for something. Each bank has their nuances. We all have like our horror stories about that one deal that we did in this industry that all blew up, and now we don't want to do anything in that anymore. So I think that that's an important thing for a searcher as you like interview lenders, to figure out like, what do you not like, and then kind of figuring out where you might go with your deal based off of that.
Yeah, and I think the interesting thing about is everyone in this room, the ones that are in our lane for self-funded searchers, you're all type A. We get it. That's why we actually like you, because you're trying to be organized and prepared, and you're trying to take into consideration every kind of possible nuance or situation that might come up and when you're in your search. But until you find the deal, you also don't necessarily know what bank is the right fit. So I appreciate you having relationships with several lenders. That's great. I think you should. Again, that's one of the reasons why we have our office hours process, so you can hear kind of our point of view, and you can start coming to know what your point of view is. And you don't necessarily have your point of view on day one. We're not necessarily expecting that. You're probably coming from private equity or investment banking, and this SBA thing is quirky. It's weird. So it's going to take you a little while to figure out kind of what the best fit for you. Like, you're trying certain things on, and you're trying to decide maybe what might feel best to you. And you could be looking at 6, 7 different industries, maybe even more than that. We're not good for ground up new construction. If you've got like, we have an HVAC vertical, for instance, great, do a lot of HVAC, it's wonderful. But if it's HVAC for ground up high rises, that's not going to be a fit. We're service maintenance. So you could be talking to us, we're getting along great, and then you find a company that is tied to ground up new construction. You decide it's a good fit for you. Fantastic. We'll help brainstorm with you. We part as friends. That's just not going to be an industry that works for us. We might be talking for a whole year. So having other lenders is great that you've talked to. You get to know us. And then when you actually identify that deal, that's probably when you're really deciding which lender to go with. And, talk to several lenders. We're good with that.
Could I add on to that too, and just maybe take it in a little bit of a different direction? One of the biggest things that, when I'm talking to folks up front, and this is just natural, I think, that everyone gets really focused on cash flow and structure. I'm like, cash flow and structure are definitely important, but everyone in this room, I'm sure, can put together a cash flow chart and figure out, like, this is what my debt service coverage is going to be, on a deal. And it's not too often that I see someone bring me something where it's like, this can't even make the debt payments back. That's one of the nice things about the space. You have a lot of sophisticated folks in the space. But one of the things I think gets under talked about is how big of a discussion it is at the bank level when we're going to our committees or talking about approval, is what is your fit for the business? And you mentioned, like, somebody who's looking at maybe 6 or 7 different industries. Like, before you even go to the bank and even have those initial conversations, you should be thinking about, how am I going to sell my skill set in order to run this business? Because that's by far and away the biggest thing that we talk about at our credit committees, is the buyer fit. Is this a business that's really complicated to run? Is this a business that's maybe a little bit easier? There's certain industries, like if you are, you want to buy a tool and die maker or a stamping company or a machine shop. We feel like that's something that you probably need to have some sort of operational experience or maybe an engineering background in to run those kind of companies. Contractors are, depending on the type of contracting that they're doing. I've worked with the same chief credit officer for 15 years. I can hear him saying it as I'm talking about it. Like, we just view general contractors as a very unique kind of business that sometimes folks from, like, a finance background or an accounting background transfer really well, but not always. So I just wanted to add on to say, when you're thinking about having those conversations, approaching banks, be sure that you've thought out, like, this is how I'm going to tell you that I'm the right person for this business. Like, I wasn't just, it wouldn't be good to say, like, well, I'm kind of agnostic, and I was, this came across my desk and it was, a 3x multiple, and, they didn't, they would take 25% seller financing. So that's why this is the deal for me. Like, that's not really the right answer. We want to hear, I don't know that you gotta, it's great when somebody's passionate about a particular industry or type of business, but certainly you gotta be able to articulate how you're gonna run. Go ahead. Can I do that, or is that okay?
Absolutely, yeah. Please.
So, like, with that, do you guys also take into account that if like, the buyer doesn't necessarily have that direct industry experience, but one of his investors does, and it's not necessarily a partner, but they're gonna have that mentor in place, or there's people that are currently at the company that you were planning on keeping in place, and maybe a manager, a general manager, something like that, where if your background is in finance, but you're trying to buy a construction business, like yes, you don't know the ins and outs, but also the seller staying on for a lengthy period of time. Does any of that come into account, or is that all stuff that you account for?
I'll say that comes into account on every deal because
Yeah.
I will say most of our acquirers do not have industry experience. It is actually more rare when we're like, oh, industry experience, you know, so it's more, you know, a really pleasant surprise when you do have that industry experience. So you mentioned all those things. Those are something we're talking about on every transaction. And transition plan, so important. The math, as Matt mentioned, the math is almost like kind of the easy part because you either have the debt service or you don't. It's that qualitative discussion around the numbers and the spreadsheets. And you can be good at the spreadsheet part. We want to also make sure you're going to be good at the operating part and you showing your work. Why does this make sense to you? We want that storyline. That's really, really important.
Yeah, and sorry, I just want to say one more thing on his question. The partial change of ownership, which I'm sure we're going to talk a little bit about, that's opened up so many possibilities when it comes to, you know, having the seller retain equity, and then that makes that conversation easier. Certainly, it's something we talk about all the time with, well, is there a key employee that would come along and maybe the searcher is willing to offer them 5% equity that vests over, a period of time. I mean, we're so concerned with that something's, going to get messed up in the transition. So that, being thoughtful about, I love when I hear a searcher say like, oh, I really want this person to stay on and I'm willing to give up some equity to make, because then it tells me that like they're thinking about the same thing that I am, that like this general manager is key to, maybe not forever, that, I mean, eventually you may figure out the business but they're really key to especially that transition and keeping them on for a period of time. I like, in perpetuity, but it's different with every deal, but definitely those types of structural enhancements are really, again, partial change of ownership, somebody coming along with you. I even had one deal a couple months ago where the seller was willing to have a limited guarantee limited to a couple $100,000. And that kind of helped us feel good that they were really going to be there through that transition period. So there's lots of different ways you can do that. And probably good to have a conversation with the lender about that, but absolutely that's stuff that can be the difference between no, this deal can't get done because we're just not comfortable with the experience, to yep, okay, we understand, we think this plan makes sense.
I will say there are some industries where unless you have industry experience, it's probably going to be a no-go, but for the most part, we're not expecting you to have industry experience. So having your investors be in the know is also helpful. But we're really liking our PGs, in the SBA space. So we're really looking at you as the operator.
Yeah, that's great. Go ahead.
You're talking about like doing the deal versus not doing the deal, but what are those qualitative, subjective buyer traits? How do those show up in the actual deal terms, whether it be the interest rate spread or the amount you're willing to loan or all that good stuff? How do you think about that?
Well, I'll just say, as far as how much we're willing to loan, I mean, the debt service coverage really does matter. So I would say generally, if we're sizing up a deal, I do want to know, at least the way it's been presented, does the price work? I mean, I'm not the multiples person. I'm the debt service coverage person. So depending on how you're structuring it, if you want to pay a little bit higher multiple, but the structure makes the debt service work, that's great. So I'm generally, my thought is, well, let's start with the debt service coverage and then let's look at all the qualitative aspects to it. Customer concentration, ties to seller dependencies, dependencies on supply chain. Are there employees that can help you transition this business? And then we're looking at, and a lot of what Matt was already alluding to, we're going to look at your background. Maybe you don't have industry experience, but what has your experience been? And how do you articulate if you're a good fit? And I will say we have seen folks that are better at doing the deal than operating the business. That happens. That you're really good at making the spreadsheets work, and you're good at negotiating the LOI. And we do have internal discussions on whether we think in this particular situation this business is a good fit for you culturally. Um, and also, can you see yourself going to a business where it's a warehouse with lots of bits of parts and pieces, and you're in a warehouse all day? Can you literally see yourself managing people in a warehouse? And we get into conversations with our clients. We actually literally talk to them. Hey, you are going to be on the road. Your job is pretty much going to be on the road, driving around in a big truck doing something. Can you see yourself doing that? I don't have a pat answer for you, Reed, but it is something that we talk about on each deal. Do you literally envision yourself running this company?
I would say, as it relates to like terms, like how do those qualitative factors, work their way into terms? From an interest rate perspective, I don't think they really do. For me, I mean, it's we're fairly narrow on the interest rates that we're doing on deals, and so it's not like we would say, well, we're not going to do this at prime plus 1.5, but at prime plus 2 3/4, we'd say yes to this. It's not like that. It could work its way into, like, maybe we say, like, okay, we want a little bit more seller financing or something like that, or very rare that we would ask for more equity. Sometimes we would ask for different seller terms or more seller participation. But I think the short answer to the question is, I don't think it really does work its way into deal terms. It's more of like we're either comfortable or we're not, and this is what you know what I mean.
And I would say where pricing comes into play is if it's a strategic acquisition. I mean, 30% of our business is for someone who already owns a company, and we're giving them their second or third loan to buy additional companies. There you've got some pricing in play.
Yeah. Well, as we were talking about different terms, I mean, one of the things that I've seen people talk about is, I've got this bank. We were talking about why would you select any given SBA lender. This bank is going to offer this lower fixed rate. Can you talk about that compared to certainty to close and what you've seen and differentiation there among banks? And then kind of the second follow-up is, I think that should be quick, but the partial standby, full standby, and then balloon notes, and how that impacts debt service with hey, first couple of years looking great, but maybe at year 5 there being a liability hanging out there. And
I think those are 6 questions.
Yeah, well, I'll tell you what.
We can get 12.
Yeah.
You just took David's job away.
Yeah,
Good segue.
I'll take the first one because I know you liked talking about the seller note stuff and how that affects debt service coverage, in the out years. So,
on Twitter.
yeah, the first your first question, I have to remember it. Yes, about the so I think you just got to try to do your best to figure out if the banks are for real. And one of the things that 5-7 years ago, I didn't do term sheets. I hated doing term sheets. In kind of the world that I came from of term sheets that you would see, I'm not going to name the name because it's being recorded, but let's say big bank, gives a term sheet to somebody for whatever the deal is. And then a month later, they come back and say, we can't do that deal at all. Like, forget about that really great fixed interest rate. Like, if we would do this deal, we would give you that fixed interest rate, but we're not doing the deal. Now, you'd see that all the time.
You would say schmargo.
Oh, I didn't say it. But you would see that all the time. Okay, so I naturally had this like aversion to term sheets. And then when my whole practice, started going into the business acquisition and self-funded search world, term sheets are just part of what people want to see. And I totally get that. And so I really had to like change around my process of how I thought about, going through underwriting. And what I did is, after it was last summer, after a deal that went through underwriting that didn't go in a way that I was very pleased about, I said, okay, I need to rethink this and change this around. And what I started doing was working up a 7 to 10-page initial analysis, taking that to our credit committee on like 3 or 4 days from getting the information. So not after just working something up, cash flow, PFS, resume, deal structure, and then getting it in front of my 5 credit committee members, talking about it and saying, okay, where are we all at on this? Are we all in agreement with what we're doing here? And then putting out a term sheet. And I say that because I think that's where you get like the interest rate quote or whatever it might be. And then, so I would really like ask questions about that. I mean, looking at how many SBA loans a bank does is a real thing. I mean, Live Oak's been the #1 SBA lender. We've been right at the top, inside the top 5. If you have somebody that you can't even find their bank name, I can't tell you, and you could probably give 100 stories of where then their credit committee looks at a search deal. They don't even know what a search deal is. And like, wait a minute, what are you talking about doing? Somebody without industry experience, with investor money? No way are we doing this. And so I think if you try to ask some of those questions, like, have you vetted this? Is this something you do all the time? How many SBA loans are you doing on, an annual basis? And if the number is, less than 50 million, I would really, start to ask some questions. But I think that's probably the best thing you can do, is to just, because, and I've seen this, I'm sure you've seen this, where somebody gets 6 weeks into, you underwrite with this other bank, you go through this whole process, and, 30, 40 days later, they're no, we won't do this deal at all. You see that all the time. So sorry for the long, I know that was your first short question. So
and just confidence to close, that's really, really important. That should be a bank's value proposition, that they can explain to you why they feel they have a big confidence to close in its process. And I will say confidence to close is worth a couple of percentage points of price. It's a good segue. Sure. And we have your question on how debt service figures on seller notes. J-curve is on every deal. And I have a couple tweets on that one too, so that's a little bit of a soapbox for me. If you're doing conventional lending, especially for our funded searchers doing conventional loans, funded searchers are backed by co-investors that are very well known coming out of more Stanford, and the J-curve is how you underwrite in a conventional setting. We know you're coming in to up-level the company. You might have to hire X number of different kinds of people. You might have to now spend money on marketing, sales. You're going to spend money to start growing that company. So your EBITDA that you just spent 3-4 times on, your EBITDA is now going down. So in a way, you actually are buying maybe a 5 or a 6 EBITDA company, because your investment thesis is you're going to do X, Y, and Z to the company. So that's one of the benefits of an SBA loan, is there aren't covenants. So if you get into this company, you thought you bought $1 million of EBITDA, and now it's really $750 because you're going to spend money to do something to it. So that's sort of planned J-curve. In lower middle market land, there's a lot of unplanned J-curve. It just happens. You lose a salesperson that you thought that was the key of why you really were interested in this business. You lost a customer. Even if the customer concentrations are only, my top customer is 7%. You lose a 7% customer a month later, that's going to cause some J-curve. And with SBA, that's why most lenders, we love your fancy investment thesis, and we know you're going to grow the company. We believe you, but we're going to underwrite to historic EBITDA, and we really want you to get in, run the company, transition it, and hopefully what you thought you bought is what you bought. But there is going to be probably some amount of depression in your EBITDA naturally. And this is where debt service coverage is an important discussion point. Lenders have different debt service coverages. We're unapologetically probably the more conservative lender. If it's industry agnostic, we want a 1.5 debt service coverage in the last full year. We have 40 verticals at Live Oak, so HVAC is one of our verticals. So if you buy a company in an industry we know well, then our debt service might be a 1.25 or a 1.35 because we really know those margin metrics like the back of our hand. But I think you should probably plan for some EBITDA depression in your transition. You know, we don't track that, but at least us, Live Oak, as lenders on the front end, we are invited to a quarterly watch list meeting. We are invited to our quarterly default rate meeting. We are invited, and these are not voluntary. So we as lenders at least Live Oak, we know our portfolio extremely well. So observationally, I can tell you J-curve happens, but we're not keeping stats on it.
We call them war meetings. We have them every quarter too.
What do you call them?
War meetings.
Warm?
War.
Oh, because it's like warm fuzzy meetings.
No,
so warm
war.
meetings.
Yeah.
Yeah.
Well, real quick, Matt, what DSCRs are you guys underwriting to?
Yeah, that's a good question. So when we do pari passu loans, we have more strict debt service coverage ratings, which we want to see at least 140 over the last 2 years based off of tax returns. When we're doing just a straight 7A deal, we don't have really a hard and fast debt service coverage rule. I would say that one thing that I do see, and I'm glad you asked that question because this is something I was thinking about this yesterday, and I was like, I want to communicate this to the group. One thing that I see this a lot, is somebody brings me a deal and it never cash flows on any tax return basis on the last 3 years because that's what we collect. But on a trailing 12-month, it does, and it's 1.8 times. And they say, hey, can you guys underwrite off of this? And the answer in almost every scenario is we cannot. Now, we don't have the hard and fast. Like I would say, if I want to see at least 1 year of solid tax return verified cash flow, and then a good interim, depending on where you are in the year, interim or TTM, what that number is. We like I said, don't have a hard and fast rule, but I think once you get like below 125, 130, I think I start to scratch my head and go, is there enough cash flow here left over for the searcher? The SBA's minimum requirement is 115, but 115 is like for a turn. Yeah, that's like a turnaround deal or a real estate deal or something. So for an acquisition, I don't think that really makes sense. Every deal is a little bit different because sometimes you have a tax return that's 130, but then the interim in the TTM is 170, and the searcher really likes the growth trajectory of the business. So sorry, I don't mean to give you a long-winded answer there, but we don't have a hard and fast thing unless it's a pari passu.
So I know there's a lot more questions out there. We're going to get to them. We're going to get them really quick. I just want to make sure that we hit on at least some of the 3 SOP changes that have happened over the last year. So we've mentioned them kind of throughout a number of your answers, but let's talk about partial change of ownership first.
Yeah.
What's the rule? How can we use it as a tool for specifically first-time acquirers, searchers?
Okay. Yeah. Okay. So partial change of ownership. We like it. Do you like it? Yeah, we both like it.
Love
okay.
it.
So the rule is because before it was only 100% buyout. With SBA, you had to buy 100% of the company, and that was your only choice. This is not seller roll. So this is partial buy-in. It's not seller roll, even though that's, I even say it too. I say it too, but it's partial change of ownership. You are partially buying into their company. The seller is going to retain some of their ownership. These are stock sales. They're not asset sales. You are buying the stock of their company. They're retaining a certain percentage. If they retain 20% or more, or they're considered key, they have to personally guarantee. If they retain less than 20% and they are not considered key, they do not have to personally guarantee. Key is going to be interpreted on each transaction. I'll give you a couple examples of where we've seen it. Maybe you can chime in on that too. So especially where licensing is required. I know I've mentioned HVAC a few times, but our HVAC verticals are very popular. especially in certain states where licensing is required if you're HVAC or plumbing. If that seller holds the license, they can retain, I don't know, 5%, let's say, maybe 10. You can use their license now. It really resolves a big hole in our specialty trade business owners being able to transfer their wealth to the next generation. This partial change of ownership really helps solve that.
Mm-hmm. Yeah, I think it's agree on all that, all great points. I think it just opens up so many more deals to searchers because there's lots of sellers out there that they don't want to be 100% out. They'd like to stay in and maybe work and, you know, have a role in the business. I actually think, and we'll see how this plays out, that, you know, we'll talk about it at SMBash 2029 about how partial changes. I'm kind of interested to see how that dynamic goes between a seller that's been running a company and owns the company and views that as my company to now I'm a searcher's coming in and they're buying, you know, in most partial changes of ownership that I've seen, it's been the seller retaining 5 to 15%. You know, I mean, I think it's going to be very rare that you're going to see a seller want to do over 20 and then personally guarantee, you know, one of your loans, but I will see. So, you know, a lot of stuff in that 5 to 15%, and I'm hoping I don't hear stories of where there's like friction between, you know, the new owner and the seller that's staying on. But I guess we'll. Yeah, it's gonna happen. It'll happen in some cases. How prevalent that is, I'm not really sure. But you know, like I said, put it on the list for 29.
And this is a place where, to your question about industry experience, we've done this a few times now, where the seller is going to retain equity. I almost said rolled equity. Retain equity, and it is really helping us get comfortable with a really nice transition and an education period for the new acquirer coming in that literally has zero industry experience.
Yeah, and just on the partial change of ownership, I think it makes it even that much more important to say, how do I get along with this person? Like, what have my you know, due diligence and everything interactions been like? Like, can I see myself working with this individual or individuals for 5 years or maybe even longer? So kind of different questions that you have to ask in those partial change of ownership scenarios.
Yeah, that's awesome. Jackie, let's go ahead and take a question now.
When I invest in a deal with a searcher, I always think the searcher should be on their own account. Do you guys have anything in your bank where you feel that the searcher should also be on the cap table so that they're investing their own deal and they can get distributions at the time instead of waiting till all of the preferred stocks pay back? Do you expect the searcher to spend money in that account?
So our requirement is that the acquirer, the guarantor, the PG, the operator, have their own equity into the injection. We want what is meaningful to our operator. Meaningful equity injection is going to be different for every single person. We want some amount of injection from our acquirer.
Or what's the minimum? Like, are you talking about
We don't have a minimum stated. I want something meaningful to you. If you have $100,000 of cash, $50,000 might be meaningful to you.
We don't have any hard and fast rule on that one either. I think it's pretty typical, or I should say, it would be atypical to see where the searcher has no, you know, equity. I don't see that all that often.
when I see people try and do it, like, that's
I
not working.
I don't know. I guess some banks are doing it. But we want something meaningful from you. And again, it's going to be different for everyone.
Skin in the game.
Oh, yeah, exactly. Let's not.
Yeah. Is that a word you like? Okay.
Let's go over here.
Just a question about working with SBA brokers.
Great question.
Yeah, I'm not sure how, you know, pros and cons of that. If you prefer searchers to go to you directly, or if you prefer to go through brokers. What are your thoughts on that?
Yeah, we talked about this. There's room for everybody. So there are more buyers, there's more lenders, there's more Q of E, there's more attorney, there's more brokers, there's more of everybody in the ecosystem now. So we've definitely talked about this. There's room for everybody. I think it sort of depends on you as the acquirer and what you're comfortable with. We have some searchers that would not consider using a loan broker because they literally want to be in control of everything. I think every searcher, regardless of whether they use a broker or just go direct, you're talking to numerous lenders anyway yourself. There are some searchers that just want that eye to eye. They want to control everything. To my point earlier, you could be working with 3 lenders. The deal you eventually pick is tough. And so therefore, in that situation, I think a loan broker is going to be really, really helpful for you. If you ultimately find a deal that maybe is, kind of more down the fairway, and you've established your relationships with your lenders, and you've got your own tools and resources, and you can make your own decision, you think pretty well, maybe a loan broker doesn't come into that situation. But if your deal might be a little bit on the outskirts, a loan broker is definitely going to be helpful for you there. And we have really good loan brokers in our ecosystem.
That's what I was going to say as well. That I think, it's part of that too is just who are you more comfortable working with. I don't think there's any right or wrong answer to that. We certainly work with loan representatives, you guys do as well. And I would say that I think, specific to the search world, the brokers that we know and that we work with that are in the search world are former SBA lenders, former people that work for big SBA banks. I think there's real value in what they're and they're not just like the almost inside banks like loan brokers, almost like a dirty word, But I don't think it's that way anymore, and I don't and I have no problem working with them. So I think a lot of it just comes down to a personal preference kind of situation.
Lisa, I was talking to your colleague Sarah last night about SBA eligibility for different NAICS codes.
What did she tell you?
She said that the eligibility changed in November.
Yeah.
You get $5 million for any different NAICS code. Is that
Correct.
okay?
We're actually doing that. And it's nice for seasoned operators. Maybe you bought an HVAC, he's saying HVAC, you bought an HVAC company. You've operated it well, you're ready to, start expanding, and now you want to buy MSPs, different days.
So you're already doing loans like
We
that
are.
today? Okay.
You got something for us?
I heard other information. What's also? Yeah. So we got a loan last year for our first acquisition. We're under LOI right now, but we're coming up against, with our current bank, eligibility issues. So we have a cap line, working capital line of credit, but they want us to lower to meet that $5 million eligibility requirement. But it's a different NAICS.
Well, it's fine.
It sounds like they may not be up on the latest and greatest SOP changes. That's what it sounds
That's
like.
what we're afraid of.
Yeah.
Question back over.
Could you walk us through the underwriting process for 504 and how that's different than 7A for businesses with commercial real estate?
Yeah, I would just say that you have to run concurrent paths with a CDC that is also approving the loan. And so you have 2 approval paths. You try to run them concurrently between the bank and the CDC, which kind of represents the SBA, if you will, in the 504. And then when they both approve, then that's they also have to send to SBA for approval. So I would just say, because I know we're probably running short on time here, I would say the 504 process underwriting takes a little bit longer than if you were just doing a 7A real estate transaction. The benefit to doing 504 is you get that great debenture interest rate, but you probably have to put a little bit more equity in, and you got to deal with a little bit more cumbersome process. Probably higher interest rate, but less equity, a little bit faster process on the 7A side. Does that answer your question?
And I would say generally there's going to be a break point. You want if it's business acquisition with real estate, right? That's what we're talking about. I think that there is a real estate size that makes sense for 504. If it's small real estate, you probably just want to put it into that 7A deal.
Yeah.
It's just much easier.
All right, so we're going to push out a couple more minutes because I know there's a lot more questions out there. Clint?
Yeah, so I want to revisit the partial change of ownership and the key definition. Have you successfully done like a 95% buy-in with a license to trade deal where the seller holds a license and is not considered key, and does not have to keep you?
We have.
Yeah.
Yes.
Yeah, we have 2.
Now, assuming that they're not the only, like, assuming that they're not the ones like wrenching the plumbing or something, you know, that they've got staff.
So they can't really just hold the license and
Yeah.
people are gonna say, oh, they're key because they hold the license.
Right, we're okay with that.
Yeah, that's
I'm
true.
just thinking 5%.
Yeah.
On the retainage.
And no personal guarantee.
Correct.
Correct.
Personal guarantee.
If you maxed out your 7A, 5 million, you still have 5 million you can use for 504.
You can if the building is considered green, or if it's manufactured. You get another 5 million to buy a building.
I was actually talking about two separate deals, so you could do that on one deal.
Yes. Yeah, the building, if say you have a $7 million purchase price of business and $5 million purchase of the real estate. Technically, you have $5 million to play with here, right? So you're use that up on your 7A, but you're buying a manufacturing facility. That's the real estate. You get $5 million there, or you green. If you go in and you change light bulbs or you do something to the building,
But that's not the newest. That's been around for a long time. That hasn't changed.
Yeah, so what, kind of piggybacking on one of his questions, where they did a deal last year, and now they're gonna do another deal. What's your time frame of doing the same buyer pool, if you will, in 2 deals? Is there kind of a threshold where you don't want to see that second deal?
Oh, like how quickly they bring the second deal? Yeah, I'll just say I have one right now that I'm working on where we closed loan number 1 in on 12/31, and now we're starting underwriting for the second acquisition. It's in the same industry, so I don't want to make sure I'm answering your question, but I think one of the things I've seen is that if something, I mean, certainly there's a lag to like default, and when we look at our portfolios, I think you probably read like 2 to 3 years, would kind of be you make a loan and if it's going to default, it's probably 2 to 3 years. But oftentimes you see those issues coming up right out of the gate. Like you have a transition problem. Clint and I were talking this morning over breakfast about. Usually it's what we see is when something goes bad, the seller pulled the wool over our eyes, and Q of E and attorneys and brokers and everyone else that was involved, or it just wasn't the right buyer for the business. And usually you can, because if they come for loan number 2, like you're going to do a lot of digging on loan number 1, and you usually, not always, but a lot of times that stuff starts to come up pretty quickly, and you hopefully can identify it.
Yeah, because you're in your board meeting,
Yeah.
in my watch list meeting, and in the first year we know if they're struggling. And that's the thing, that default rates don't consider or capture businesses that struggle also. And I would say on the cadence there for second acquisition, we talked about the J curve. Well, you're transitioning your first company. How is it doing? If your EBIT has gone down after you bought the first company, after the first 8 months, you might not be giving you that second add-on if you're in a J curve situation. But I mean, a good portion of our deals, 30% of our pipeline is giving additional acquisitions for add-ons.
Just real quick, I would say, I tell people this all the time. When you're coming for loan number 2, the number 1 question I ask is, how is loan number 1 doing? Because if the answer is good, loan number 2 is usually easy. And if the answer is bad, loan number 2 is impossible.
Yeah,
So,
and if there's a long answer, well, let me walk you through what's happening. You're like, no.
yeah.
All right, I'm getting the cue to wrap up here, so we'll do one more quick question and then we'll wrap up. Does anybody have just a quick one that we can wrap off real quick? Yeah, let's go right here.
Just on the previous question, I know default rates are low, but what would you say for your specific experience, the default rates are, then in addition to that, how often do you reject?
Oh, I don't know that I could answer that question. I mean, I'd be happy to answer it. I just don't know that I don't keep up on that or get that information like on an updated enough basis that I could say like, this is what that, 3.5% or something like that. And I'll tell you what, I will get you that information, but I don't want to quote it off the top of my head and be wrong because, yeah, I don't know, Lisa, if you have a
Shows you how much he pays attention in the war meetings.
It wasn't my deals. That was
Yeah.
somebody else's deals.
Well, at Live, I know exactly what the answer is, but I'm not going to share it. I think the SBA stat is between 2 and 3% default. And this is the reason why this is tough, because you all want a really cut and dry answer. And it's just because of the thing I just said. Businesses can struggle and pay us back, but not through the business operations. They could be paying us back because their spouse makes money outside of the small business operation. So to answer your question, if you need a specific answer to decide if this is a good fit for you or not, I would say it's not a good fit for you. If you really want to know, statistically speaking, what are my odds of this not working out well? I think the SBA stat is 2 to 3% default. But I would say there is a fair amount that struggle, and that statistic isn't captured anywhere.
Gotcha. Perfect. Well, Matt, Lisa, thank you very much. Any closing remarks, and tell bashers how they can find you after we leave the stage today?
You can find me anywhere, I guess, around here. I would just say in closing, I find something that you.
It's Yogi Bearish.
Was it?
Like a Yogi Bearism.
Well, I'm getting very old and gray. I would say the thing that I get most excited about is when people bring me something that they really love. I mean, most people that buy a business, you're going to be operating this business probably for longer than you think, and make sure that it's something that you're really going to enjoy spending the next 5, 7, 10 years of your life doing. That would be what I guess my parting words would be.
Purpose. The reason this is so exciting for us that have been doing this for a long time, and I could be doing anything. I don't have to be here doing this thing that I'm still doing, but I love it. My purpose is to help coach and mentor the next generation of entrepreneur. And I think, especially where interest rates are today, if you find an opportunity that you are passionate about, and it's where you want to be, and you can really envision yourself there, I think this is a fantastic time to be doing what you're doing. So go get it. Go get it.
Awesome. Wonderful. If everybody can please give them a round of applause. We appreciate it. All right.